When geopolitical conflict appears in global news, financial markets often react almost immediately. Prices begin moving even before most people fully understand the situation. Oil may spike, stock markets may fall, gold may rise, currencies may fluctuate, and suddenly, traders around the world begin asking the same question: what is happening to the market? In today's video, I want to explain something very important for every trader and investor to understand: how geopolitical conflict impacts financial markets. Not from a political perspective, not from a dramatic perspective, but from a psychological and financial market perspective. Because when geopolitical tensions rise, markets are not only reacting to facts, they are reacting to expectations, they are reacting to fear, they are reacting to uncertainty, and most importantly, they are reacting to human behavior. If you stay with me until the end of this video, you will understand why markets move so quickly during geopolitical conflicts, which financial assets react the fastest, and how professional traders stay calm even when global news creates chaos. And if you want to develop strong trading psychology and emotional discipline during volatile markets, consider subscribing to Bull Mindset. This channel focuses on the mindset, discipline, and psychological frameworks that help traders stay consistent in uncertain environments. Now let us begin with the most important concept. Financial markets dislike uncertainty. Investors can adapt to good news. Investors can adapt to bad news. But uncertainty is what creates the strongest reactions. Geopolitical conflict introduces uncertainty into the global economic system. When tensions rise between countries, investors begin asking many questions. Will trade routes be disrupted? Will global supply chains be affected? Will oil production decrease? Will governments impose sanctions? Will economic growth slow down? The problem is that during the early stages of conflict, no one knows the answers to these questions. And when investors cannot predict the future clearly, they begin adjusting their positions. This adjustment creates volatility. Now let us talk about the markets that react first during geopolitical conflict. One of the fastest reacting markets is the oil market. Oil is closely connected to global politics. Many major oil-producing regions are located in areas that experience geopolitical tensions. When conflict threatens oil production or transportation routes, traders immediately begin anticipating supply disruptions. Even if actual production has not been affected yet, markets often react to expectations rather than confirmed events. For example, if traders believe oil supply might decrease in the future, they may begin buying oil contracts immediately. This buying pressure can cause prices to rise rapidly. Now let us talk about stock markets. Stock markets represent expectations about future economic growth. When geopolitical conflict appears, investors begin worrying about the impact on the global economy. Businesses may face higher costs. Trade between countries may slow down. Supply chains may become unstable. Consumers may reduce spending. Because of these concerns, stock markets often become volatile during geopolitical events. Investors may sell stocks to reduce risk. Large institutional investors may shift their portfolios towards safer assets. This movement of capital can cause significant market fluctuations. But there is another asset that often reacts strongly during geopolitical conflict: gold. Gold has been considered a safe haven asset for centuries. When investors feel uncertain about the stability of the global financial system, they often move money into gold. Gold does not depend on corporate earnings. It does not depend on a specific country's economy. Because of this perception, gold often attracts demand during periods of geopolitical tension. However, it is important to understand that even gold can become volatile when markets react emotionally. Now, let us talk about currency markets. Currencies represent the economic strength and stability of nations. During geopolitical conflicts, investors sometimes move capital into currencies that they consider safer. For example, currencies from countries with stable financial systems may strengthen as investors move their money into those economies. Meanwhile, currencies connected to regions experiencing political instability may weaken. These movements reflect global capital searching for safety. Now let us go deeper into the psychology behind these market reactions. Because financial markets are not purely mathematical systems, they are human systems. Investors, traders, and institutions make decisions based on expectations and emotions. When geopolitical conflict appears, fear and uncertainty increase. Investors may worry about worst-case scenarios. Even if those scenarios are unlikely, this fear can cause rapid market movements. Sometimes markets react more strongly to fear than to actual economic impact. For example, a headline about escalating tensions can cause prices to move quickly. But later, when more information becomes available, markets may stabilize again. This happens because markets initially react to uncertainty rather than confirmed outcomes. Now let us consider a real-world style example. Imagine that news breaks about a conflict near a major oil-producing region. Within minutes, oil prices may begin rising. Energy company stocks may increase. Airline stocks may decline because fuel costs could rise. At the same time, gold prices may increase as investors look for safe assets. This demonstrates how one geopolitical event can influence multiple financial markets simultaneously. Another example involves trade restrictions or sanctions. If countries impose sanctions on each other, certain industries may be affected. Manufacturing companies may face supply shortages. Shipping companies may face delays. Technology companies may lose access to certain markets. All of these factors can influence stock prices and investor expectations. But there is something extremely important for traders to remember. During geopolitical crises, markets often become emotional. Price movements can become exaggerated. Investors may react quickly to news headlines without fully analyzing the long-term impact. This is where trading psychology becomes critical. Professional traders understand that volatility is part of the market. They expect uncertainty during global events, but they do not allow fear to control their decisions. Instead, they slow down. They review their risk management rules. They focus on protecting capital. Because the biggest mistake traders make during geopolitical crises is emotional decision-making. Let us talk about a powerful mental framework that professional traders use. Separating information from reaction. Just because news is dramatic does not mean your trading decision must be dramatic. Professional traders observe how the market responds to news rather than reacting instantly. They analyze price behavior. They look at volatility. They evaluate risk. This allows them to remain objective while others panic. Another important framework is position size control. During geopolitical uncertainty, market volatility can increase suddenly. Prices may move faster than usual. Professional traders adjust their position sizes accordingly. Reducing position size helps maintain emotional control. When risk is manageable, the mind remains calmer. Now let us talk about a simple mental exercise that traders can use during crisis markets. Before entering any trade, pause for a moment and ask yourself 3 questions. What is my risk if I am wrong? Am I following my strategy or reacting to news? And can I accept this loss if it happens? These questions create psychological distance from emotional reactions. They allow logic to return. Another helpful exercise is zooming out. When geopolitical news appears dramatic, traders often focus only on the present moment. But markets have survived many crises throughout history: wars, financial crashes, pandemics, political instability. Yet markets continue functioning. Zooming out reminds traders that volatility is temporary. It also helps them maintain perspective. Now, let us discuss something even more important: control. Traders cannot control geopolitical conflict. They cannot control global politics. They cannot control economic uncertainty. But traders can control their reaction. They can control their risk management. They can control their discipline. And they can control their mindset. This is the difference between emotional traders and professional traders. Emotional traders try to predict everything. Professional traders focus on managing uncertainty. If this video is helping you see financial markets more clearly, consider subscribing to Bull Mindset, because this channel is dedicated to building traders who stay calm when markets are not. Let me leave you with an important final thought. Geopolitical conflicts will always appear in the world. Markets will react. Prices will move. News will create noise. But the traders who succeed are not the ones who react the fastest. They are the ones who remain the most disciplined. They observe the market. They manage risk carefully. They follow their strategy. And they remember that emotional control is one of the most powerful advantages in trading. When uncertainty increases, calm thinking becomes even more valuable. Trade carefully, stay disciplined, and always remember that the strongest traders are not the ones who predict the market perfectly. They are the ones who control their mindset during uncertainty. I will see you in the next video.